If you don't want to worry about money ever again, and if you don't want to have to rely on a job to earn a living, then there are 7 places where you should invest your money, and I will discuss all 7 of those today. Hello everyone, and welcome back to the Finance Guardian channel. Now, no one can predict the future. No one knows what tomorrow will bring. What you need to do is to educate yourself about finances and then be prepared for any situation. While you may love real estate and stocks, you should be aware that neither of these assets can move straight up forever. They all pass through their own cycles. There are times when real estate will generate cash flow and turn a significant profit. Other times it will be the stock market, or other times it will be another type of business. So instead of simply guessing what the best thing to do is, you have to be the person who is financially savvy and can perform well in any economic situation. To make sure you will never have to worry about working for another paycheck, here are 7 investments you need to make. This way, you have money coming in whether the economy is booming, whether it is heading sideways, or whether it is collapsing. Let's get right into it. Number 1, real estate. The most common way that real estate offers a profit is by appreciating, which means it increases in value. This can be achieved in several ways for various types of properties but can only be realized through selling. It is possible to increase your return on investment on a property in a number of ways. If you borrowed money to purchase a property, you can refinance the loan at a lower interest rate. By reducing your cost basis for the property, you will be able to clear more money from it. The second way real estate generates wealth is through regular income payments. Generally referred to as rent, income from real estate can take many forms. Let's take a closer look at some of the ways that you can earn income from residential properties. Number 1, buy and hold. This is one of the more traditional ways of making money from real estate. This can be done in a number of ways. You can buy a single-family home and rent it out. Purchase a multi-family home and live in one unit while renting the rest, ideally to cover your mortgage and your own housing expenses. Or you can purchase a multi-family home and rent out all of its units, either managing the property yourself or hiring a management company to handle renting out units, collecting rent, and handling any repairs that might arise. Number 2, flipping. Flippers add high return fixes to houses in a short period of time and then resell them. Flipping can be highly profitable if you know where to find properties to fix up, have the skills to carry out the renovations yourself or oversee a crew of contractors, and have a fair idea of what property might cost and what its potential is. Number 3, Airbnb and vacation rentals. Home away from home rentals have become increasingly popular in recent years, as many travelers prefer them over staying in hotels. You can earn income by renting out a house or even a room on a short-term basis, especially if the house is located in an area that is popular with tourists. Number 2, passive stocks. If you can't beat them, join them. This is the mantra of passive stock investing in a nutshell. In contrast with a number of other strategies, this one does not try to outperform or quote-unquote time the stock market with an endless stream of trades. Passive investing is based on the idea that the key to maximizing returns is to do as little buying and selling as possible. Through passive investing, an investor seeks to avoid the fees and limiting performance of frequent trading. Passive managers generally believe that outthinking the market or sector is difficult, so they aim to mimic their performance. Passive investing replicates market performance by building well-diversified portfolios of single stocks, which could require extensive research if done individually. With the introduction of index funds in the 1970s, achieving market returns became much easier. In the 1990s, exchange-traded funds, ETFs, that track major indices like the SPDR S&P 500 ETF SPY simplified the process even further by allowing investors to trade index funds as if they were stocks. Number 3, growth companies. Growth investing focuses on increasing an investor's capital. Investors in growth companies typically invest in startups and small companies whose earnings are expected to increase at a faster rate than the industry sector or market as a whole. Most growth investors seek investments in rapidly expanding industries or even entire markets where new technologies and services are being developed. Capital appreciation is what they're looking for, that is, the gains they'll achieve when they sell their stock as opposed to dividends they receive while holding the stock. Most of these companies are young, small, and have excellent potential. A few of them may have also just begun trading publicly. It is projected that the company will achieve prosperity and growth, and that this will translate into a rise in stock prices in the future. As a result, growth stocks may have a high price to earnings ratio, P to E. At the moment, they might not be earning, but they are expected to do so in the future. It's possible that they have access to patents or technologies that allow them to be one step ahead of their competitors. To stay ahead of competition, they reinvest profits into developing even more innovative technologies and seek out patents to ensure longer-term growth. Number 4. Cryptocurrency. Cryptocurrency is a form of digital, electronic-only currency intended to be a medium of exchange. It has become a hot property, particularly in recent years, since dollars have flowed into the asset, driving its price higher and drawing even more traders to the market. Bitcoin has become the most widely available cryptocurrency, and its price fluctuates a lot, which attracts many traders. For example, the price of Bitcoin rose from below $10,000 a coin at the start of 2020 to around $30,000 at the beginning of 2021. From there, it doubled over the $60,000 mark before taking a dive. The start of 2022 was rough for cryptocurrencies as traders increasingly sold their positions and most top cryptos declined dramatically. However, many cryptocurrencies, including Bitcoin, are coming off of highs, and it isn't uncommon for them to fluctuate quite significantly before rising further again. Despite these ups and downs, those who bought and held may still be sitting on some pretty nice gains. Unlike other assets, though, it is not backed by the FDIC or a government or a company that has the power to generate money. Instead, its value is determined by what traders are willing to pay for it. Number 5. High Yield Savings Account. Having a high-yield online savings account will pay you interest on your cash balance. High-yield online savings accounts are accessible tools that can help you manage your cash, just like regular savings accounts at your brick-and-mortar bank. Online banks usually offer much higher interest rates because of their fewer overhead costs. You will also usually have quick access to the funds if you transfer them to your primary bank or use an ATM. Savings accounts can be an effective tool for individuals who need to access cash in the near future. A high-yield savings account is a good option for risk-averse investors, and in particular anyone who needs money in the short term and doesn't want to take the risk of not getting their money back. Deposits in these accounts are insured by the FDIC, so you won't have to worry about losing them. In spite of the fact that high-yield savings accounts are considered safe investments, such as CDs, you run the risk of losing purchasing power due to inflation over time if rates are too low. Number 6. Roth IRA. IRAs, either traditional or Roth, are savings vehicles for those who realize how important it is to plan for retirement. The process of opening an account is easy using an online broker or with the help of a financial planner. An important characteristic of a Roth IRA is how contributions are taxed. Traditional IRA contributions are made with pre-tax dollars, meaning they reduce your taxable income when you make them, and you pay income taxes when you withdraw the funds. Roth IRA contributions, on the other hand, are made with after-tax dollars. When you make contributions, no tax break is offered, but they can be withdrawn tax-free at your discretion. Whenever you earn a dividend or interest on your investments, the amount is added to your account balance. The amount of your account earns depends on what investments are in it. It is important to remember that an IRA is an account that holds investments that you choose. They are not investments themselves. Your money is put to work through those investments, allowing it to rise and compound. Even in years when you are not able to contribute, your account can still grow. The interest you earn is added to your balance, and then interest is earned on the interest, and so on. The growth generated by your account can increase each year thanks to the magic of compound interest. Number 7. Gold. There are several ways to invest in gold, including exchange-traded funds, ETFs, purchasing stock in gold miners and associated companies, and purchasing a physical product. There are as many reasons for investing in metals as there are ways to do so. Gold's importance in the modern economy lies in its ability to preserve wealth throughout thousands of generations. One cannot say the same for paper-denominated currencies. To put things in perspective, consider this. In the early 1970s, 1 ounce of gold was worth $35. Suppose at the time you had the option of either holding an ounce of gold or simply keeping the $35. Both of them would buy you the same items like a brand new business suit or a fancy bicycle. However, if you had an ounce of gold today and converted it to today's prices, it would still be enough to buy a brand new suit, but the same cannot be said for the $35. Simply put, if you held the $35 as opposed to the 1 ounce of gold, you would have lost a significant amount of wealth since the value of gold has increased, but the value of the dollar has been eroded by inflation. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please remember to hit that like button. If you're new around here, subscribe to our channel, and on your way out, please do remember to click on that bell icon too so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.